Hi, another one of our revision videos for IB Business Management. This is Final Assessment 2023 and it's 3.4 Financial Accounts. Starting point is to understand who are stakeholders and what is the purpose of accounting. Stakeholders are any individual or group who have an interest in operation of a business. And the purpose of accounting is 3 C's. It's collection, classification and communication of information. And now that information is used by stakeholders to make more effective decisions. So link accounting, link stakeholders, and it's simply about providing information to allow effective decision making. Now, for the purposes of the exam, you need to be able to create examples of stakeholders and their interest in accounting information. Here's a whole list. Use common sense. Once you think of a business and think of a stakeholder, it becomes straightforward. So the employees are interested in profits. Why? That's the basis of their pay claim. The government interested in profits. Why? Is the company paying sufficient tax? Or are they looking to use what's called window dressing, which will come up later in this video? Potential investors, profitability, liquidity position, now in forecasting the future. Is this a worthwhile investment? So keep it simple. Do not look to memorize all of these. Just use some common sense. Say, owner of a business, what are they interested in terms of the numbers of the business, in terms of financial information of the business. Now, syllabus talks about principles and ethics of accounting practice. This becomes a tad theoretical, and some students become confused. Yes, they are the principles there on the slide in front of you. Look below the slide. The bottom line is businesses and accountants who advise businesses need to be professional, need to be confidential in the use of information they have hold of. They need to have objectivity and integrity, because what you actually are looking for at the end of the day is businesses who do not look to manipulate their profit figures and their asset and liability figures to encourage falsely investors to invest money. To pay a lower amount of tax to the government. So again, you're looking for true and fair view. The information provided should be produced on the basis of principles and ethics. Now, IB specify the formats they use of the financial statements they will assess you on. First one is profit and loss account. Now, this is the IB layout, and you need to learn it. Now, issues, classification of the information is on the right-hand side. But problems I find students have is how it's actually put together. So keep it simple. Sales revenue is just simply the money you earn from selling goods or services. You subtract from that cost of goods sold. Now, the cost of goods sold is simply the cost to you as a business of the goods or services you have sold to earn that revenue. That gives you gross profit. Now, I always use a simple example with the students when I'm teaching this. Think you run a market stall. Sales revenue, you're selling fruit, vegetables, whatever it is on your market stall. That's the revenue you earn from selling the products. What's the cost to you? You have bought those fruits and those vegetables at hopefully a far lower price than you're actually selling to customers. So therefore, the gross profit gives you an indication of the trading performance of the business, because you're looking for the largest difference possible between sales revenue and cost of goods sold margins. Again, that will be coming up in future videos on ratios. You subtract from gross profit expenses. Expenses are simply all of the other day-to-day operating costs of a business. That gives you net profit before interest and tax. Now, that profit figure is useful because it gives you, sometimes you'll see it referred to, not IB purposes, as operating profit. It's the profit earned by the business as a result of its normal day-to-day business activities. Then you subtract the interest you pay on your loans, you subtract the tax you owe, and you subtract the dividends. Now, dividends are payments to shareholders. Those individuals who have bought shares in your business, it's a return on their investment. And what you're left at the end of the statement is retained profit. The retained profit goes back into the balance sheet, and I'll show that link later on in the video. So simply, what is the statement? It's a communication device. It's a communication device in this instance to show the revenue and costs and the profit or loss a business has made. If that statement is accurate and is produced on the basis of principles and ethics, okay, you end up with a piece of information which can be used by stakeholders to make informed judgments. Now, the balance sheet, a longer statement, and I'm using the IB format, but this is spread over two parts of the video. Now, the difference between the balance sheet and the profit and loss simply is the balance sheet is looking at the financial strength of the business in terms of its assets, what it owns, and its liabilities, what it owes. But it follows the same principles as the profit and loss account. It's a communication device which is used by stakeholders simply to make decisions. Problems, construction, and what is subtracted from what, and what the various items mean. So you start with fixed assets. Your fixed assets are your long-term assets. Now in accounting, that's an asset you intend to use for greater than 12 months. Now, other than land, assets are subject to depreciation. Depreciation is loss in value. Now the fixed assets there are shown at what's called historic cost. And that's the cost to the business at the time of the purchase of the asset. The depreciation is how much those assets have lost in value. Take one from the other, you end up with net fixed assets. Then you look at current assets. Current assets are your short-term assets, and they're defined as cash or anything you expect to turn into cash within 12 months of the balance sheet date. Now you add those current assets together, and just below that you'll see current liabilities. Current liabilities are short-term in the sense of amounts of money you have to pay back in less than 12 months. Okay, examples there, add them together. If you subtract current assets from current liabilities, that provides you with net current assets, also called working capital, and that figure is taken across the right-hand side there in the column. Now, working capital is the amount of money you have to operate the business on a day-to-day basis. Then, look at the right-hand column, look at the net fixed assets, look at the net current assets, working capital figures, what's happened. Yeah, that gives you total assets less current liabilities. Then you factor in your long-term liabilities. Those are amounts of money you have to pay back as a business in longer than 12 months' time. Things like mortgages or bank loans which you've taken over greater than 1 year to pay back. So subtract one from the other, you end up with a net asset figure. Now your first problem is study this example and just ensure you can see where all of the figures come from. It is, in essence, simple arithmetic. You're just adding and subtracting. But you need to understand which numbers go in which sections of the statement. Because what IB can actually do in terms of the exam paper, they will not give you the format, but they can actually just give you a list of those numbers and expect you to put it together and understand how the format's constructed. The net asset figure at the bottom, in reality, is assets minus liabilities. So everything you own, take away everything you owe. And if you have a positive figure, obviously that's a positive in the sense of the business is moving forward, and you're looking if that figure is actually increasing. Why? The net asset figure is the value of your business. That's the value you're placing on your business. So the first part of the statement has actually given you assets what you own, liabilities what you owe at a particular point in time. So a stakeholder can look at that statement, start making judgments, compare this year with last year, look at 5-year trends, look at the economy, look at your steeple, what's happening out there, what's likely to happen to this business in the next 12 to 24 months. Now I've included here the bottom section of the balance sheet. It goes from net assets to finance by. In the finance by section, you have share capital, which is simply money the business has earned from selling shares, and you have accumulated retained profit. Now this links back to the profit and loss account. The last item on the profit and loss account is retained profit. That's the amount of profit earned for that year after taking into account all of your costs. Now that amount is transferred to the accumulated retained profit in the balance sheet. It is simply a reserve, it's a source of funds. Now add them together, you have equity. Now equity simply is the shareholder's stake in the company. That is what basically shareholders own. It's their money. If you study accountancy further on down the line at university and or as a career, there is what's called the balance sheet equation. It's not required for IB. But the top part, the net asset figure, is your use of funds. The bottom part is your source of funds. So why does equity equal net assets? The figure at the bottom, the equity, that's the money shareholders have. And what have they actually done with it? They've invested it in assets. They balance off. But there's a whole double entry bookkeeping system going behind that you do not need for the exam. Now, pointers to make is accumulated retained profit. It will go up if you made a profit for that year, which is transferred from profit and loss account. What most businesses tend to do, if you heard the phrase writing off a loss, they use their reserves. And the easiest way, if you've made a loss for a year, that loss has to be covered, has to be dealt with. You just reduce your accumulated retained profit figure. Now, with the final accounts of non-profit entities, all you have to do is look at the format for the profit entity balance sheet and identify the differences for the non-profit entity. Most of it is just terminology, but literally go through and put the statements together and identify differences, and then it becomes very, very straightforward. So, evaluating final accounts. Look at the possible limitations. Trend analysis. On their own, financial statements are limited in the sense that they are normally 1 year and at a particular point in time. Stakeholders need to have the whole picture. So realistically, you're looking at 3 to 5 years. You're looking for trends in profitability, trends in changing factors which are causing profitability to increase, decrease, etc. This will then allow you to make more definitive conclusions and correct decisions. Human resource factors. Look for those non-financial factors which are essential to success. So the business may be profitable at this point in time, but a senior manager who has motivated, retained key staff, has left, as from the new year, after the end of the financial year, you may have a problem. What's going to happen? Are the staff going to stay around for the new manager? Are they going to be motivated? So going forward, what are those non-financial factors which could also impact on performance? Not just as at this point in time, this one day when the statement's actually produced. This is position, but again, what's likely to affect that position moving forward? Competitor analysis. So with your trends, look what's happening with your competitors. So you establish the trend that your profit is on the way down, which again is a negative. But if the rate of decline of your profit is far slower than that of your major competitors, it's not such a negative factor. It gives you possible sort of basis for success moving forward. And in terms of they're in a worse position than you. Look at the business environment. The business environment is volatile. The business environment is constantly changing. So those statements, one point in time, what's going to happen in the environment? It changes potentially day to day in terms of its impacts on financial factors and also financial statements, financial performance, and decision making. Take all this back to decision making. Stakeholders need the information to make decisions. Something else which causes confusion for students: intangible assets. You have tangible assets and intangible assets. So from a fixed asset point of view, a tangible asset would be the fleet of company cars. Now, intangible assets are provided here, the International Accounting Standard IAS 38 definition, just to be technically correct. But if you had to summarize this down, simply intangible assets are assets which do not have a physical presence. They cannot be touched. So things such as patents, trademarks, licenses, royalty agreements, etc. However, the issue for businesses, intangible fixed assets can be exceptionally valuable. And back to the principles and ethics of accountancy, you need to show a true and fair view of the business. So assets are items which are owned and represent value and represent the strength of the business. So you need to value a business fully. You need to look at the intangible assets. Do you need to have all of those examples? No. Make sure you can quote, I'll say 3 to 5 maximum from that list. Also, goodwill's mentioned. Teachers, or you may have come across the term goodwill. Goodwill simply is an intangible asset which only appears when you sell the business. And it's an amount agreed for reputation, contacts, and presence. Now, I sold a business years ago, and the problem you have here is valuing intangible assets. The accountants who were dealing with the business sale said goodwill. I said, right, how much? And they came up with a figure. How did you come up with that figure? Their simple basis was they'd made it up on the basis that the other side were going to offer 50, 60, 70%, possibly lower than what they were looking for. And you'd end up somewhere in the middle, agreeing amount for this. So the difficulty you have with intangible assets is how do you accurately value them, because they should be included in your balance sheet, and your balance sheet is used as a communication device by stakeholders. That's one of the major issues with intangible assets. And it also allows businesses the opportunity to manipulate their accounts to either, present the impression that the business is stronger than it actually is, or even weaker than it actually is if it's a potential takeover, and they're trying to frighten people off both ways. Depreciation, HL only. And depreciation is simply loss in value of fixed asset. Now make sure you can quote reasons why a fixed asset could lose value. Easiest one's wear and tear. It simply runs out. Have a look at obsolescence. Link obsolescence into passage of time. If you guys out there using iPhones, think iPhone 4. You can still pick up a second-hand iPhone 4. You'll buy it for next to nothing. Think about the latest iPhone that's out there. Think about the value of that. That's all simply depreciation is in terms of background understanding. But there are some calculations coming up. The first calculation is called straight line method. Very, very simple. What did a fixed asset cost you? What is it worth at the end of its life when you decide to get rid of it? Residual or scrap value. Divide it by the useful life, i.e. how many years you intend to use the asset for. Now, this provides you with a figure, and that figure stays the same for every year. That's the loss in value of that asset. Okay, it's as simple as that. Now, for the first exam under new syllabus, May 2024, they've got rid of reducing balance method and use units of production method, or also called units of output method, seen as a more reliable method of depreciation, particularly for machines, photocopiers, cars. In essence, what you're actually doing is calculating even depreciation on the basis of the output produced. So you can calculate depreciation per mile, per kilometre driven by a car, per copy of photocopier, printer, etc. So all you actually do, calculate depreciation per unit, formula is given there. Once you have it per unit, to calculate the depreciation for the time period, just multiply the depreciation per unit by the number of units produced in that time period. I say, allegedly more accurate reflects the actual loss due to use of the non-current asset. When evaluating your depreciation methods, just keep it simple. Straight line method, easy to calculate, but it's unrealistic. Trying to think of a non-current asset where the loss in value will be the same every month, every year, etc. That's unrealistic. The use of output method is seen to be more realistic, because it links loss in value depreciation to actual use. But the main drawback is it's a more complex calculation. If usage output changes, you have multiple calculations to work out the unit of depreciation to use to work out the total depreciation expense.